just simply put, if you don't know the purpose, don't take the loan. I mean, you're not just taking it willy-nilly out there, right? Because those loans, you do need to have a plan to repay them.
Fourth law of wealth of always invest in yourself, right? And
Yeah.
the seventh one is just review annually. And you kind of, and it could even be more frequently. Review annually, update roles, targets, policy design as life changes. Because again, Jeremy, what's guaranteed?
Folks, welcome to another episode of WealthWise Banking. I'm here today with Jason Sipple, and we want to talk about something that's kind of near and dear to our hearts. And those are a little bit about governance and rules around borrowing from your personal banking system. Now, a lot of folks will go out and borrow with basically no structure in mind, and that's good for some plans if you want it to fall apart, right? So in this episode, we want to lay out a couple ground rules. They'll be durable, flexible, kind of use them the way that you think, but this is more of a guide on how to borrow from yourself. These rules are going to make sure that your dollars keep working for you, that your loans are purposeful, and that your family is actually aligned. So growth in the policy, as we all know, it is tax deferred. You can access it tax-free via the loan structure. And that's really what I want to get in today, is that when you take policy loans, what is the plan in place to repay those policy loans? And kind of what happens if you don't? So again, we'll always tell you, family bank, infinite banking, none of this is actually an investment. It's actually a cash flow system, and it bridges the gap between saving and investing. So Jason, welcome to today's episode.
Hey, thank you, Mr. Jeremy Lee Huggins. It's always great to be here with all of you, all of our listeners. And like you said, planning or failing the plan is what?
A
Planning to fail.
plan to fail.
It is a plan to fail, and it is what most people do. Not you guys, because you guys are better than that. You guys are uncommon, and you're already willing to show up to invest in yourself with your most valuable asset, right? Your time, your energy, your focus. So I'm excited to jump into this to talk about how we're going to have a purpose before a purchase, how every loan request is going to tie to a family objective, something that you're looking to accomplish, right? You have to have a destination to get there. Otherwise, you're never going to make it anywhere. And how you don't interrupt the compounding when you use your policy system versus just going and taking a loan from their system, right?
Mm-hmm.
So, and it does so many other things than that. We're going to dive into all of this, but how do you really set this up to where your family stays protected, where you stay in control, and where you still maximize all of the guarantees that is inside the specially engineered plan that we talk about all the time?
Yeah. So if you are sitting, if you're at home, there are 7 main discussion sections we're going to talk about today. And these are only food for thought. This is kind of what Jeremy uses kind of as a guidance on how to take policy loans and how I have a plan in place and the structure I use to repay a lot of my policy loans as well. Um, your structure can be different, right? This is your personal banking system. What we're talking about today is simply a guide on how we do it. So, number one, Jason kind of alluded to it, purpose before purchase, right? So, every dollar needs instructions. And so, what we like to do is tie every loan to an actual purpose that's going to extend our generational wealth. So, we require that to be written down. Why do we require a written purpose for every loan, Jason?
Well, if you don't have a plan, it's the same thing we said at the beginning, right? You're going to fail. You don't want to steal the peas, Jeremy, to quote Nelson. We don't want to be stealing from the family bank, so we want to have every time we take a loan, we need a plan to pay that back to fill up that banking system that we're borrowing from.
Yeah, absolutely. Right. So the clarity will beat out willpower every single day. It's like I may have good intentions, but until you write it down, like what matters is measured. We'll have a full episode full of cliches by the end of this one.
No
But
kidding.
clear,
No kidding. I
yeah.
thought you were asking me something about I was thinking this is like when I quizzed Jeremy. I don't know what answer he is thinking wants me to have. So I'm just going to
Yeah.
say what's on my brain. So,
Yeah. So when you have, I mean, think about what the personal banking system is, right? What is infinite banking? Like we like to start out with purpose before purchase, but that means that you actually have to have some sort of value in place. And so we want to make sure that the purpose is aligned with your stated values, with your family values, right? We have a previous episode that talks about a family constitution, and Jason kind of alluded to how he took a weekend getaway with his family every year to talk about their values and their purpose. Well, these loans that you take, they should have that sort of same guidance and direction, right? Whether it's reducing debt, if it's purchasing equipment, if it's funding your child's education, You want to avoid some drift so that way you avoid loan regret.
And that's one of the places we're starting, right? So we're again we're giving you not only kind of the thinking behind how you utilize your system, but we're also encouraging you to take action with systems and processes. So again, this is how Jeremy does it. I'm gonna interject how our family has been using our loan system and how we have a plan every time and kind of what that looks like. But at the same time, this is up to you to decide what's best for you.
Yeah, I think just simply put, if you don't know the purpose, don't take the loan. I mean, you're not just taking it willy nilly out there, right? Because those loans, you do need to have a plan to repay them, and so you should have a purpose before purchase. So that's number one. Number two, don't interrupt compounding, right? So loans, what do we get into that? That's kind of getting into the loans versus withdrawals. And a lot of folks don't understand that you actually have two different options when it comes to these policies. To access the cash value, you can take loans or you can take withdrawals. Jason, what's the difference?
Well, one, it's just like it sounds like. It's not very complicated, right? When you take a withdrawal, you are actually drawing capital out of your system that you have contributed. So you are interrupting the compounding. You are reducing the capital that's in the system that could earn you a guarantee or a dividend. And it also is taken away from the amount that is earning you guaranteed interest. So when you take a loan, which is the preferred way to use your system, you're taking that loan tax free. You're taking a
Mm-hmm.
tax-free loan. That is the preferred way for the majority of the times. I don't really know a lot of good reasons why you're taking withdrawals out of a system. I guess there could be some, but I'm not really aware of too many.
Yeah, we just have a simple rule, right? Loans by default, withdrawals only by exception. And to that point, if you don't have an exception to the rule, then just continue with the loan process.
Yeah. And the next one is, I mean, we're kind of right. You did number one, you did number two, number three. Always have a repayment plan.
Oh yeah,
Now,
this is the big one.
the source, the timeline, and like Jeremy says, document that baby. Get it documented somewhere, put it down in writing, and have a plan. So that means this is like picking a date to get something done. Don't let Parkinson's law creep in when you're taking a loan. We're already having Connor Patrick do this when he wants to buy a computer. Is how fast are you going to pay back your loan? Are you doing a year? Are you doing 18 months? Are you doing 20 months? And that way you can kind of do the math, figure out what the interest is. And now not only are you paying yourself back, you're earning interest on whatever it is that you purchase that goes back into your system. And it's going to reduce the beautiful part, Jeremy, is if you're using a non-direct company, it's going to actually reduce the simple interest. And it might take it from a 6.75% or a 5% or a 6%. But when you actually have the plan and you pay it back, guess what? You're actually increasing the spread, the margin on that middle column of that loan that you're taking because that actual interest paid is probably going to be around 3% or less.
Yeah. Another great thing that I love about the repayment process, right? This is the opportunity to teach financial IQ to your kids. So you talked about with Connor. Let's say that Connor wanted to go out and take a business, right? I want to set up a lemonade stand, Dad. I want to go sell this door to door. Well, we can do that, but we're going to set up a repayment schedule because we're going to use your policy as a teaching tool. And now instead of getting the loan from Fannie Mae, Freddie Mac, or getting the loan from American Express, instead they're getting it from the Bank of Dad. And the
Hmm.
Bank of Dad, just like anyone else, you're going to set, like you said, the amount, the source, and the timeline. So if he wants to take a policy loan for a lemonade stand, you're going to set him up kind of like a promissory note, right? Hey, you're going to pay me back from this cash flow on this rate every single month for a 12-month period, and you get to keep anything over and above. Like that's teaching financial IQ at a young age.
And that more than anything, right? Think about what we talk about all the time. We were groomed to give up control of our money. We were taught to assume the risk. And so when we start having the blessing of having those conversations, it's a game changer, folks. It's a game changer to tell your kid like, "Hey, great, you want to take a loan from your policy? Well, how are you going to repay that back? Like, what are you doing to bring value to the family where we would have had to pay someone else to do the weeds, to mow the lawn, to do the editing on videos, whatever it is that they can have that earn gig?" I even told Connor today, I'm like, "Hey, I'll give you 10 bucks if you read, this emotional intelligence 2.0 book I want you to read it and give me a report. And I think I told him $12, but it's recorded now live that it was 10. But the whole point is you start finding ways where they can add value versus saying, "Hey, hand me something," right?
Hmm. Yeah,
And
absolutely. So the real, I guess, rule of thumb that backs up this one is if there is no plan, there's no loan, right? You
yes,
have to set up a repayment schedule. And let's go a little bit deeper on why. If you don't repay your loans, what happens to the death benefit? Well, the death benefit's deducted. The outstanding loan amount is deducted from the death benefit. And if we're trying to create generational wealth, you're going to rob Peter to pay Paul. You're going to take away from your future beneficiaries. So you want to have that repayment schedule in place, not just for financial IQ, but to be good stewards of your family's generational wealth.
that's powerful. So, and number four, maintain a liquidity floor. This is actually one that you came up with, Jeremy, and I love
Mhm.
this one. This is the 6 to 12 months of your core expenses as an opportunity reserve. Because remember, if your banking structure is going to be the foundation that you're building all your financial wealth on, well, then you want to not strip it down bare, run it on empty, and just hope it's going to work out. You want to maintain some liquidity inside your system for the what, or for the, Jeremy, what's the one constant in life, brother?
Change
Wow, you're so excited by that.
and death and taxes.
You, yeah, everybody still wants to say that, but it's just change. Like death is change, taxes are change. Like it's just all the same
Yeah.
thing. It's just change.
Yeah, so the liquidity floor, that's a huge one, right? Especially for someone like myself who did not come from money. You always want to have that emergency buffer, that savings. And that liquidity floor, it really is sacred, right? You want to have that written down. And you should consider reviewing that every year, right? Life changes, to Jason's point. And your liquidity floor might end up evolving. It might go up, it might go down. It all comes back to what are your needs? What are your monetary needs? As you get older in life, maybe you don't need as much capital. Maybe your investing has slowed down, but you always want to have that liquidity floor in place. And so if you go to take a policy loan to that point and you're going to dip below the floor, pause, reflect. Maybe you need to scale down number three, which is having the repayment plan for the loan. Maybe you don't take as big of a loan. All right. See how these are starting to build on each other?
Yeah, maybe, some of that is going to be our human psychology. What is driving that decision? Is it FOMO? Is it someone said, "Hey, this is only going to be available for this period of time"? Guess what? As long as you have the gold, opportunities will find you. Things will find you. The reason to maintain that is you don't want to take on unnecessary stress or risk or put more pressure on your system. It'd be like taking your sports car and running it to red constantly. Guess what? It's over engineered to run on red for a while, but if you do that over and over and over again, guess what? It's going to break down. It's going to have problems. It's going to cost you a lot more than it was worth just to, go fast once in a while, right?
Yeah. Yep. And I also think of it as the permission slip to actually go out and invest. I feel more comfortable knowing that I actually have a buffer, that I have a level of safety, that I have a level of liquidity. Because to Jason's point again, life happens, change is inevitable. And you want to make sure that if the investment or the opportunity or whatever ended up happening, wherever you took that loan for, remember, you want purpose for the loan. But if it didn't go according to plan, it's a lot better to rebound from a position of strength than it is from weakness. And that liquidity floor gives you that peace of mind.
Yes, that's well said. And number five, document decisions. It,
Oh, yeah, big one.
it's
Document.
just a bit, and this is going to evolve too, Jeremy. I feel like you're gonna put down. Maybe this is something that's going to guide your trustees in the future. If you're the trustee at this point, if we're talking about using a trust, the what, the why, the amount, the expected return on the investment, the value, like what, how is that adding value to your family, to yourself? Is it something that's going to be like a magical experience for everyone, where it's kind of a life expanding experience? Is it going to be something where it's adding value as far as maybe it's a new skill that increases your upside to earn and bring more money into your system? Is it an investment that you're making where you're expected to get so much per month, or at the end you maybe get some kind of balloon at the end? What does that look like? And start putting down the what, the why, the amount, and any other notes, because eventually I believe that's going to lead to seeing patterns on your decisions.
Yeah, absolutely. You will see patterns. And the other thing is you can cross verify against point number one. Remember, purpose before purchase. When you write down the reason that you're doing it and all the expectations, you can then compare it to, is the purpose for maintaining the generational wealth? Is the purpose actually stated? And are we validating what it is that our system, our entire infinite banking system is designed to do?
Yes, and this is fun. I like how we're going through this. We did number five. Now number six is teach as you go. And Jeremy, I had a breakthrough this morning, brother. Can I share?
Yeah, absolutely. This
Okay,
is a
so
better time than any.
yeah, and this is, you guys say, how, Jason, how does this relate to infinite banking and what you're talking about? Just bear with me for a second. I like to go off on little tangents. But I was riding this morning, Jeremy, and I really didn't want to. It really sucked. I'm kind of feeling beat up, but I still went out. I rode because why? I always feel better. And it's not just for me, it's for everyone around me. And I went back like a decade ago when I was racing triathlon all the time. So all I did was work and train. I worked and trained. Like I literally would come home some days at 6 or 7 p.m. and I hadn't got my swimming and I'd go back to the gym and swim until the gym closed and then come home and then just pass out. And and I thought I was leading by example. Okay. So number six, by the way, is teach as you go. Teach as you go. So small supervised loans for heirs to build financial IQ and EQ. So I was just leading by example, but I wasn't telling anybody or setting standards or expectations for anyone around me. I was just like, oh yeah, maybe they'll work out. I hope they pick up my habits and they'll see how hard I'm working. They'll see how hard I'm training, the results of getting better all the time, of going from like being last to like being an all-world athlete according to Iron Man. And now fast forward and the things I'm sharing on our show together, right? Like that we developed this to do exactly what we're telling you guys. Now my family's involved. Now I see each and every one of us has something that we're working towards, something that we're excited about, and we're able to like instead of just doing by example, you have to stop and have the conversations
Mm.
because that's where the real learning comes from is stopping and having the conversation be like, hey man, how was your workout today at the gym? What did you do? Oh, that's cool. Like, how is that getting you closer to your goal? Do you see what we're doing? We're starting to measure and monitor. Like, hey, I know you told me you wanted to do this by then. Like, are you able to do that many push-ups or that many pull-ups by now? Right? You start having, well, why not? Like, what is holding you back? And so teaching as you go, this is where a lot of the magic happens. As a parent, as someone that's teaching financial things, it's these small, unplanned moments of checking in that's going to build that IQ, EQ.
Yeah. And for folks who are wondering, what is financial IQ, right? Well, that's how the money works. What is financial EQ? Those are the habits, the patience, the stewardship, right? That's passing along the values about money, our relationship with money.
Yes. And you want to go any deeper on that one, that teach as you go? Because again, the difference, right? If you're following to break down what I just said, don't expect others to understand what you're doing because you're leading by example. That is not leadership. Leadership is when you look around you and you have one, two, three, four, 10, 100 people that are able to do what you're doing and take your lessons, and that is legacy.
Yeah.
And that's
If we
what
want
we're
to
all looking
just
to create.
I mean, to bring it back to the lemonade stand as an example, right? So if your kid
I
wants
got
a
thirsty, man.
loan,
I had to get some drink when you said that.
so if your kid wants a loan, like start with a small loan, start with like small and scale over time. If they're coming to you for a lemonade stand, ask them to give you a sales pitch, do progress check-ins, right? Put together the repayment schedule. It's the responsibility of growth over time. And so what are the limits of this? Let's talk about it, right? This is the opportunity to use the policy as a system to teach financial IQ, again, how money works, financial EQ, the habits, the patience, the stewardship around money.
The EQ is the feelings, like the understanding that money is just a tool. Because even though we say it all the time, when money, like if you don't accept money in and you don't love money and you don't respect money, guess what? Money's not going to find its way to you. It's a relationship.
Hmm.
And so having those deeper conversations that sound a little woo-woo to me, but at the same time, it really is Because you get to a point financially, like I heard someone wealthy talking about this, like, yeah, how do people charge $50,000 for, an hour of their time? Well, they get to the point where they have so many things going on, they don't really have an hour. And so if someone really wanted an hour of the time so they can not make the same mistakes that that person did, to get that knowledge, it might be worth 10 times that $50,000.
Mm.
And really understanding that cost is only a problem in the absence of value, and starting to really understand, like, changing that relationship with money. Like 50,000 for an hour, that's crazy. I would never do that. Well, why not? If it gave you a $500,000 return, would you maybe reconsider?
Yeah, there's a couple videos and clips I've seen of people talk about that. It's like, would you take this? Would you do that for this sort of amount? It's like, well, would you take that gamble? It's like, no, I'm not going to gamble, but I'll make an educated, decision on this thing.
Which is
Uh,
around the fourth law of wealth of always invest in yourself, right? And
yeah,
the seventh one is just review annually. And and it could even be more frequently. Review annually, update roles, targets, policy design as life changes. Because again, Jeremy, what's guaranteed?
change, baby.
Change. That's right. Change. And so, maybe this rolls into other rhythms you have in place with your family, or maybe you have a weekly money meeting. Maybe it's just an hour. Maybe you have a quarterly review. And then annually, like maybe you spend a day every quarter going through everything: what's coming in, what's going out, what does this look like, what are our policy loans, what's upcoming. And you start being more proactive to all of the different things going on financially in your life. And then you can start updating the roles of targets. Who might you need on your wealth building team that you haven't thought of yet, right? Like this is going to start introducing some of the other measuring and monitoring pieces that make this whole system work.
Yeah. So just kind of the recap, right? Again, these are a little bit of our guidelines on how we do policy loans, how we decide to repay them, the structure that we use. So number one, purpose before purchase. If you cannot state the purpose in one sentence, don't borrow from your banking system, right? Number two, don't interrupt the compounding. The loans are better than the withdrawals. The simple and fast rule, loans by default, withdrawals only with exception. Number three, have a repayment plan, right? If you don't have a plan, you don't take a policy loan. You have to have a repayment plan. Number four, maintain a liquidity floor. Your liquidity floor, it's sacred. So write it down. Make sure that you're constantly reviewing it. You might have to make updates to it over time. Number five, document your decisions. Just use a one-page form. What we're looking at is patterns to Jason's, point. Write down what it is, why you're taking it, the amount, the expected return on investment, the decision date, right? Just document what's going on. Number six, teach as you go. We're really focusing here on financial IQ, the how money works, financial EQ, our relationship with money. And lastly, review annually, minimum annually, right? This is part of your governance. Why do we review each year, right? People's roles and targets, new guardrails, those things can change. So make sure that you're reviewing because your system is going to change and you need to make the appropriate updates so that way you're not staying stagnant. Like be like water to Bruce Lee's point,
Mm. I love Bruce Lee quotes, man. So that was perfect. That was perfect for the moment. Well said. And as you see, it's just a simple framework. We keep giving the simple frameworks on how you can utilize this system, how you can make this work for you, and just the guidance on, well, how do I go about it on a daily basis? Just follow these 7 steps. Keep it simple. Keep it really simple because again, you don't know anything until you do it, right? You train by learning, you test by doing, and you teach. That's when you accelerate. So if you go to the sixth point, go start teaching this process to another family, to somebody else, and you'll start learning more about what you're doing really well. And when you say certain things out loud, you're like, yeah, it's kind of stupid. It doesn't make any sense. Maybe we should meet more often, or maybe we should document that more clearly, or maybe instead of putting it in a file folder somewhere, maybe we should have it up on a drive in the cloud somewhere where other people know where it is other than us.
Yeah, and if you have like your own set of house rules, if you're out there becoming your own banker and practicing this yourself, and there are things that you think we should include, comment. write it in the notes. Let us know. Like the audience, we're all here collectively together, right? So I'm learning from you guys on a daily basis, just as much as you guys learn from us by tuning into the podcast.
Amen on that. Amen on that. And, bringing it full circle, like Jeremy said, if you're thinking, hey, I want to know how I can apply this in my life, well, you're at a crossroads. Every time, make the decision. Are you going to take action, or are you going to keep saying, you know what? I should maybe do that. Pick a date, go to our site, go to wealthwisebanking.com, book a call with us, have a conversation. There's no cost. That is the free piece of chicken. Come in. We will assess where you're at. We'll assess where you're trying to accomplish today and where you're going in the future. And we'll have that conversation for you. So, Jeremy, as always, we're already in banking.
You're just not the banker yet.
Be blessed, y'all. Thank you for your time, your energy, your focus. Jeremy and I are not confused. You are here, unlike most people, learning about this stuff.
Take care. We'll see you next time.
Next time.
Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.